Let's begin. Number 1. The house of cards was made of mortgages. Imagine giving a $500,000 loan to someone who just quit their job, has no savings, and thought credit scores were only for video games. Welcome to the American mortgage market in the early 2000s, where banks handed out home loans like free samples at Costco. No income, no problem. Terrible credit? Here's your mansion. Can't read the loan terms? Even better. These were called subprime mortgages, which is a polite way of saying, we know you probably can't pay us back, but we'll deal with that later. And how did the banks deal with that? They bundled these junk mortgages into shiny financial products called mortgage-backed securities, MBS. Basically, it was like duct taping a bunch of moldy bananas together and selling them as a high-end fruit basket. Ratings agencies like Moody's and S&P gave these bundles AAA ratings because, hey, what's capitalism without blind trust and a fat conflict of interest? The logic was simple. Housing prices always go up, right? Spoiler, no, they don't. Number 2, the derivative dumpster fire. Here's where it gets extra spicy. Banks and hedge funds weren't satisfied just selling radioactive mortgage bundles. No, they invented credit default swaps, a fancy term for betting on people not paying their mortgages. Think of it like buying fire insurance on your neighbor's house and then flicking a match toward his curtains. AIG, the insurance giant, wrote hundreds of billions in these swaps without keeping nearly enough cash to cover losses. Because what could possibly go wrong with gambling on an entire nation's ability to pay rent? Meanwhile, Wall Street geniuses packaged MBS into even more exotic beasts like collateralized debt obligations, CDOs. CDOs were the turducken of financial weapons, one garbage loan wrapped in another, then deep-fried in delusion. When one mortgage failed, it was like lighting the fuse on a fireworks show of exploding liabilities. In short, Wall Street was playing Jenga with dynamite. Number 3, when the music stopped. Picture a musical chairs game with billion-dollar chairs, and suddenly, boom, the music stops. In 2007, people started defaulting on their mortgages. Lots of people, like millions. Turns out if you lend someone a small fortune and they have no job, they might not pay you back. Who knew? Housing prices didn't just stall, they crashed. Foreclosures skyrocketed, and suddenly those mortgage-backed securities were worth less than the paper they were printed on. Banks realized they were holding flaming bags of worthless assets, and everyone started panicking. Bear Stearns was the first major domino. In March 2008, it collapsed like a drunken game of Monopoly. JP Morgan Chase bought it for $2 a share, less than the price of a Starbucks latte. Investors? Screwed. Employees? Screwed harder. Then came the big one. Number 4, Lehman Brothers and the day the earth stood still. September 15, 2008. Lehman Brothers filed for bankruptcy. A 158-year-old Wall Street titan vaporized overnight. Gone. Just gone. It was the largest bankruptcy in U.S. history. $600 billion in assets torched. You know your economy is on life support when your top investment bank dies mid-deal. The government let Lehman fail, thinking it would teach Wall Street a lesson in risk. The government let Lehman fail, thinking it would teach Wall Street a lesson in risk. Instead, it taught the global economy how to have a heart attack. Markets around the world went into cardiac arrest. Banks froze lending, credit evaporated, stocks tanked. Banks froze lending, credit evaporated, stocks tanked. Iceland's entire financial system collapsed, and your 401k became a 21k. People stopped trusting banks stopped trusting people, and trust, it turns out, was the only thing holding this rickety financial circus together. At that point, the economy wasn't just broken, it was actively on fire. Number 5, bailout bonanza, aka capitalism with training wheels. So what do you do when your financial system is eating itself like a cannibalistic piñata? You throw money at it, a lot of money. Enter the Troubled Asset Relief Program, TARP, a $700 billion government lifeline. Think of it as the US Treasury grabbing a fire hose full of taxpayer dollars and spraying it directly into Wall Street's flaming dumpster. Banks like Citigroup, Bank of America, and even automakers like General Motors got bailed out. Because apparently when you crash the economy while wearing a $6,000 suit, you don't get arrested, you get a bonus. The idea was, these institutions are too big to fail. Translation, if we let them fail, the rest of the economy will also spontaneously combust. So the government made it rain, helicopter style. And the irony? A lot of these same bankers who helped cause the crisis got record bonuses the very next year. Nothing says oopsie like a $10 million yacht upgrade. So yes, trillions in wealth vanished, millions lost homes and jobs, but hey, Goldman Sachs was fine. Sleep well. Number 6, Main Street got mugged. While Wall Street sipped bailouts like mimosas, Main Street was face-planting into the pavement. Unemployment skyrocketed. Over 8 million jobs were lost between 2008 and 2009. Entire neighborhoods turned into foreclosure graveyards, boarded up homes, underwater mortgages, families evicted by the hour. Small businesses crumbled, retirement accounts imploded. People who thought housing is always a good investment suddenly realized they were stuck with a $300,000 loan on a house now worth $180,000. Oh, and remember that magical American dream? It packed up, sold itself on Craigslist, and moved to Canada. Meanwhile, regular folks didn't get a bailout. They got austerity, budget cuts, shrinking services, and lots of thoughts and prayers from the same politicians who voted for the Wall Street rescue package. It was the ultimate economic plot twist. The people who didn't crash the car were the ones paying for the tow truck. Number 7, the rating agencies that rated garbage as gold. Let's talk about the ratings agencies, Moody's, S&P, Fitch, the financial world's referees. Their job? Tell investors how risky a financial product is. Their actual job during the crisis? Stamp flaming piles of junk with AAA and call it a day. Imagine your smoke alarm giving a thumbs up during a house fire. That's basically what these agencies did with mortgage-backed securities. They gave the riskiest, most toxic products in human history the highest possible safety rating, like saying a haunted house made of termites is earthquake-proof. Why? Because the banks paid them to rate the securities. That's right, the same people selling the explosive were also bribing the guy checking for bombs. It's like hiring your mother to review your restaurant on Yelp. Totally biased, totally glowing, and totally misleading. These fake, safe ratings helped trigger the global collapse because pension funds, insurance companies, and international banks all trusted them. Turns out, when your financial guidance comes from a magic 8-ball in a suit, the results are suboptimal. Number 8. The invisible hand was drunk and belligerent. Economists love talking about the invisible hand of the market, guiding supply and demand with magical wisdom. But in 2008, that hand wasn't guiding, it was slapping people in the face. Deregulation played a starring role. The Gramm-Leach-Bliley Act in 1999 essentially told banks, hey, go ahead and be everything at once. Commercial bank, investment bank, hedge fund, casino, YOLO. The SEC, Securities and Exchange Commission, loosened leverage limits for big firms, allowing banks like Lehman and Bear Stearns to borrow up to 30 times their capital. That's like trying to balance an elephant on a pool noodle. There were also no rules on credit default swaps, thanks to a law championed by a certain Alan Greenspan-style belief in markets self-regulating. That's like letting toddlers supervise each other with flamethrowers. Basically, the financial system turned into a high-stakes game of Jenga, played by caffeine-addicted gorillas, and when it fell, they all acted shocked. The free market wasn't broken. It was doing exactly what it was allowed to do: extract maximum profit with minimum accountability. until the entire tower collapsed. Number 9. The global domino effect. Remember how the US thought it could contain the damage? Yeah, no. The 2008 crisis went global faster than a cat meme. Banks in Europe had bought truckloads of those toxic mortgage-backed securities because nothing says safe investment like American homebuyers with zero income and 3 jet skis. When the US market tanked, European banks caught the plague. Iceland's entire banking system collapsed. Ireland went from Celtic tiger to Celtic timeout. Greece basically threw its financial stability into the Aegean Sea. World trade froze. Stock markets worldwide had panic attacks. Developing nations that had nothing to do with subprime mortgages suddenly saw their economies contract. Why? Because the global economy is like a Jenga tower built by overconfident toddlers, and when one block sneezes, everyone eats glue. Central banks worldwide had to coordinate emergency actions just to keep money flowing. The US Fed became the world's biggest lender because apparently America decided to export debt along with democracy. Moral of the story? When Wall Street sneezes, the whole world ends up in intensive care. Number 10, the great blame game. Who actually caused the crisis? Depends on who you ask. Some blame the banks for giving out ninja loans, no income, no job, no assets. Others blame the borrowers for buying homes they couldn't afford, as if they were financial toddlers left unsupervised at a Lamborghini dealership. Some say the Federal Reserve kept interest rates too low for too long. Some blame Fannie Mae and Freddie Mac, the government-backed mortgage twins who turned into full-blown enablers. Others look at regulators and laugh, because what regulators? Reality check. It was a perfect storm of bad decisions, greed, denial, and too many people hoping the money machine would never run out of ink. In short, everybody built the bonfire, but nobody brought a hose. Wall Street blamed the government. The government blamed Wall Street. The middle class blamed everyone. And the bankers? They blamed unexpected market turbulence, which is rich coming from the same guys who built the turbulence machine in the first place. Number 11, Occupy Wall Street and the rage hangover. After the dust settled, people looked around and realized, wait, the rich got richer, the poor got foreclosed, and nobody went to jail. Cue Occupy Wall Street, the protest movement that began in 2011 with a simple message: we are the 99%. Translation: we're broke, you're not, and we noticed. Thousands camped in Zuccotti Park demanding accountability, regulation, and an end to the absurd wealth gap that had only gotten worse since the crisis. It was less a movement with demands and more a collective scream into the void. Meanwhile, Wall Street CEOs were back on CNBC talking about market confidence while sipping $14 lattes on private jets. Accountability, please. The Department of Justice barely prosecuted anyone from the top firms. Some settlements happened, yes, but they were mostly civil fines. And let's be honest, when you're worth billions, a $200 million fine is just the cost of doing business, like getting a parking ticket for crashing a plane into a school. So while regular folks were still clawing their way out of the financial abyss, the institutions that helped build the bonfire were already planning their next barbecue. Number 12, lessons we pretended to learn. Here's the part where we tie a nice bow on the crisis and talk about the lessons learned. Except, did we? Yes, some reforms were passed. The Dodd-Frank Act tried to tighten oversight, create consumer protections, and monitor systemic risk. The Consumer Financial Protection Bureau, CFPB, was born, a federal babysitter for the banks. There were stress tests for banks, new capital requirements, and an attempt to reduce risk-taking. But Wall Street is like a hydra. You cut off one risky behavior, it grows 2 new ones, now with blockchain. Many argue that Dodd-Frank got watered down over time. Lobbyists worked overtime to carve loopholes the size of yachts. Some banks just shifted risky behavior into the shadow banking system, where regulation fears to tread. Derivatives didn't vanish, they just got new names. Meanwhile, housing prices surged again, student debt ballooned, and financial literacy remained somewhere between meh and what's a credit score. In other words, we built a slightly stronger dam while still partying downstream like the flood's never coming back. And that, folks, is how a few greedy suits broke the world and still made it home for dinner.